All right, y'all. Now we're gonna get into Fibonacci. Let me see if I can spell this right. I spelled the other thing wrong, and I never fixed it, but whatever. Yeah. Now we're gonna get into Fibonacci retracements. Fibonacci retracements. So basically what the Fibonacci retracements, what it is, it's a tool that we use to measure retracements. And retracements are nothing more than the market retracing its move to a specific percentage. So now Fibonacci, if you research, then you understand what it is. Broken down the golden ratio, and all of that stuff. You can Google it. Google where Fibonacci came from and where that name came from. But basically, these numbers that we're going to use within the Fibonacci tool are all ingrained in the psychology of humanity and the psychology of nature itself. And because what people don't understand is they think the market is actually dead and it's just candlesticks going up and down, when the market is actually alive. And what it is a collective unit of psychological responses. So it's like if you have 10 people in the room and they all have the same mental impulse, which forces them to, or emotional impulse, which forces them to do an action or to act a certain way, then that itself is going to show itself in life. So one candlestick will basically show what everyone in the market at that one specific time is thinking. So if you see one nice bullish candlestick, one nice push up like this, what that represents is the psychology of the market, is basically the collective psychology of everyone who's trading, is their decision is they're deciding to buy. And the higher it goes, it just means that's the more that we have people who are actually in the market who's trading, who are buying. So the Fibonacci basically goes off the psychology of human nature, the psychology of everyone within the market, and it measures the retracements. A retracement is basically this. So this is an impulse. When you see a candlestick shoot up to one specific direction, remember when I told you in market structure module, this is an uptrend, right? So this right here is the push up. This is an impulse. You know what I'm saying? This is an impulse, and this is considered a retracement. So this is the market retracing back its steps from this impulse. So it's basically going back. It's like saying, I'm going to walk to the store, it's 20 miles, but let me retrace my steps back 10 miles before I get to the store because I forgot my keys or I forgot something. This is the retracement before it shoots back up. The Fibonacci measures this retracement and allow you to, if this is an uptrend, allow you to set in and enter again and have a nice perfect entry from the retracement. So Fibonacci itself, if you use that itself, you'll make a lot of money if you know how to use it effectively. So like with this, we can measure it going down here, put in a buy, and take all of this impulse, this whole impulse. You know what I'm saying? This is one of the tools I primarily use. Now, where you can find this, let me pull it out. This is the white one. Is right here. This is a Fibonacci. So basically what you're seeing here, that's crazy because I drew 50%. Basically what you're seeing here is the market shot up and it retraced 50% back to its actual impulse before it shot back up and crosses a zero line and shot all the way up to negative 61. So that basically is telling you it retraced only halfway, so there's likely a chance that it's still going to continue. Let's say if it retraced all the way down to 78, there's a chance that for it to retrace like this, that just means that there's a lot of force going against the actual push up. So for it to retrace this far back, it means that now the buy trend, for it to go back to go up, the buy trend is basically dying down. So 78 usually mean that the market is starting to die down. I mean, that trend is starting to die down. You can start looking for sells or a break of structure first. So you'll see something like probably like this, where it hits the 23 and then structure breaks. So now when structure breaks, this will create a downtrend, and then you do the same thing, right? You wait for it to retrace and you draw your Fibonacci, another 50%. So we use this to measure. We use this, and it's a perfect measuring tool because it allows you to not predict what's going on, but you can kind of get on the side of the market instead of going against it. The side of the trend instead of going against it. This is how I use it. I don't know how a lot of people use it differently, but this is how I use it. So let me just clear everything. Oh, I don't want to clear that. Okay. So now what we're going to get into, so what we're going to get into though is the actual numbers, the prominent numbers when dealing with Fibonacci. Number one, we're looking for a retracement at a 61.8%. Number two, a retracement from the 50%. Number three, a retracement from the 38, I think it's 38.2. 38.2%. These are the main retracement zones. Write this down. These are the main retracement zones. If you gotta pause the video, but write this down. Now, number 4 is what I call speed bump. These are speed bump retracements. So we have 4 being, I'll call it a 23%. I don't trade it. I just look at it. A lot of times it's a speed bump retracement. Like it might retrace off there for a little bit and just continue. I don't really too much pay attention to 23% unless I see a harmonic forming or something like that. But that's something way advanced that I don't really want to get into right now because we're talking about Fibonacci and not harmonics. And then the 78%, 78 to 88. 88%. These I don't pay attention to. If it lands anywhere on one of these, I don't consider the trade valid. It has to land on one of these. So, for instance, let's say we have this, right? 61%, we good. 61% shows it comes at 61%, right? So like, okay, so now we're gonna wait for a candlestick pattern, a reaction up here, probably a doji, or a or for it to start consolidating, or we're gonna wait for something up here before we take the sell. Once we get it, this will be our first target, second target, third target. I'm gonna get into that later, but for right now, I'm just gonna speak on Fibonacci, just the not the Fibonacci, not the exit, like the extensions and the exit strategy, but just the entry strategy with Fibonacci retracements, and just so you can kind of understand what it is. If it hit up here, I'm not touching. If it hit down here, that's cool, but if it hit down here, I'm not touching. So we can say this zone is the green zone. It's the go zone. Like it's legit. It's the legit zone, right? So these numbers, keep these numbers, memorize these numbers, right? Just memorize them, because these numbers, they're gonna serve you well. These numbers right here, they're gonna serve you well. They're the numbers that's going to basically ensure that you get paid. So let me go ahead and move on to the actual chart, how to set up the Fibonacci, and also how to and the reactions that happen within those zones, so you can kind of see what I mean by this is what we use to actually see reversals, to get back into the market, to get back into the trades, and so you can see it, you know, as a candlestick chart and not just a drawing. So let me get back to that on the next video. This was just a rundown on Fibonacci. Remember, 61.8, 50%, 38.2. Those are the magic numbers for Fibonacci. So let's get it.